Guys, we're going to talk about stops and limits and how these, these things can honestly help you, save time so you can do the things you love. So you can save yourself time by setting buy stops, sell stops, buy limits, and sell limits. So what they are stops and limits that I'll show you a picture when I finish this this slide. But they are situations where if price is at a certain point, but it's not at your resistance or support level yet, and once it gets there it's going to reverse, or it's going to tank all the way down, or skyrocket all the way up, you can put a placeholder there that's called either a buy stop, a sell stop, buy limit, or sell limit, which means whenever it hits that point, it will get you in the trade. So you don't have to be on your phone and click buy or click sell. You can just put one of these stops or limits in, walk away, and then check back in 5 hours and see if you're in the trade or not. See how it says right here? You can leave. You can go to the gym. You can be with your family. You can do all of that. Once it gets to that area, it will get you in the trade with your stop loss and take profit. But you got to set, obviously, your stop loss and take profit yourself. This can be really beneficial for people who have no aspiration to sit in front of the charts for all day, which is most of us, damn near all of us. And also for those who aren't used to setting alerts yet. More on that in the upcoming series. We'll definitely talk about that more so in I think series 3 and series 4. We talk about how alerts can help you get in the market at your time and on your own standards. Only con, sometimes with the limit, price can get very close to your area and not hit it and go in the direction you predicted. So let me show you exactly what a limit is. Yeah, so I will have this attached to as a PDF. You can kind of see it clear as day here. I'm going to show you on the actual trading view as well. So look at this. A buy stop. Let me go on trading view so I can show you side by side as well. So a buy stop is if price is right here and whenever it gets here, it's going to skyrocket up. You can place a buy stop right here. So whenever price is going up and you're sleeping, you're at the gym, the minute it gets here, it'll get you in. Order placed above price and price keeps going up. So price is right here and you're waiting for it to get, let's say for instance, let's just say you had a resistance here. I'm just saying, just for example, right? And you put a buy stop that says whenever price gets here, get me in the trade for a buy, and price is down here, but I don't want to sit in front of the charts for a few hours. Then you can place that buy stop there, and the minute it hits it, it'll get you in for a buy, and then obviously you're making profit. A sell stop is the same thing. If price is above and you see whenever it gets down here, it's going to go right through it. Then you place that sell stop right there. The minute it hits it, it'll get you in. So again, for example, if price was right here and you had, you had like a support level right here, you could say whenever price gets right here, get me in the trade for a sell when you're going somewhere, and it'll get you right in. Now, buy limit and sell limits are different. So a buy limit is price is going down and you have a support right here. What a buy limit is, I believe that, I'm not saying, like I know this for a fact, I'm saying like if I'm a trader, what I'm betting with a buy limit is that when price gets to this support level, I think it's going to go back up. So I'm going to place a buy limit at my support and just, predict that it's not going to go down any further. So for example, you can place a buy limit right here. And let's just say price is up here. It's going down, 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 but your major support level was right here. Price is going down, down, down. It hits it. It goes a little bit further, but it hits it. And now you're in for a buy. So whenever price is going further, you're losing money, but now it starts to rally, and now you're all of a sudden making a lot of money. Sell limit, the same thing. Price is going up, but you have a resistance here, and you're predicting that whenever it hits that resistance, it's going to go back down. So same over here. If you had a resistance right here and price skyrocketed, and you felt like this is one of your major resistance areas over here as well, price hits it, and now you're in for a sell, and then it drops. So it's imperative to understand what limits and stops are, which one you can actively use. I want to have this as a PDF so you can keep it for your notes all the time, so you can understand what you're doing. But aside from market execution, because obviously everybody knows what market execution is, it's basically you open your phone, you click buy, you click sell, you're automatically in. But with a stop or a limit, you're basically saying that you're going to get in whenever price gets to a certain area, just not now, and then you just let price do its thing and you take your time. So I hope this video helps you guys out a lot. So this is going to be a very quick video. It is, currency pairs for beginners, like the pairs you should be looking at if you are a beginner trader. It's literally this simple. Between this four, I may even throw USD, Switzerland in here, U Chief, but which is like the little slang term we call it. But other than that, Euro USD is the most, highly traded pair in Forex in general with, traders, banks, government, all of that in general. GBP USD is close behind, but Great Britain and USD are like, two of the biggest economies out there in this market. And it's not as wild as the yen pairs. Like Japan, like these yen pairs are crazy. Like they go up, down, like they're so volatile that these four pairs that I'm trying to, advise you guys to look at as beginners. Just look at it. It's very, very slow. It's relaxed. USD CAD. Canada imports a lot of oil to the United States, so they work together a lot, but it doesn't, like, the pair isn't super volatile. Like advanced traders won't really look at UCAD too much because it's not as fast as they would like it to be, but it still moves. Like, don't get me wrong, you guys gotta understand that Euro USD, Australia, USD CAD, they still move, a good decent amount to make some money. But the more money you make in here, the more you're just like, oh, I need more money faster. Let me trade gold. Let me trade GBP AUD. Let me trade GBP JPY. And I'm just like, relax. Like, stick with the majors. The only major I wouldn't say trade is USD JPY too much because even though it's a major, it trades like it's a minor, and minor pairs are more volatile than majors because they're not as traded. You know what I mean? So these are the four pairs I would implore you guys to at least study, go over, mark your charts up on them, to see how they move. Don't do it just yet. Like, continue on with the series 1 and series 2, and understand how to mark charts up, and how to get perfect entries, and how to get out at a good time based on your support and resistance, or based on your Fibonacci extension levels, or a previously wicked area in the past. All of that is in series 2. But what I want you guys to realize right now is, don't focus on gold. If you are a beginner and you're trying to come in trading gold, you are in for something. If you're trying to come in and you're trying to trade, GBP AUD, you are in for something as well. Like, don't try to trade, crazy exotic pairs. That's not what we need to do. We need for you to trade pairs that are like slower, they're relaxed, but they get the job done at the end of the day. So if anything, trade Euro USD. Look at it. Like I said, it's the most widely traded pair. Move to GU, UCAD, and AU. Stay with these four. And if you want to, throw in the other majors like New Zealand, USD, and United States, Switzerland. But the goal is for you guys to understand how these major currencies work, and understand how slow and relaxed they are. Because if you can work on your strategy in a slow environment, and a slow market, then we can start working on how you'd be in a more volatile market, and then we can start switching pairs to see how you would do if the market was a little bit faster. But stick with these pairs, work on your strategy, and then build your way up. And as the series goes on, we start getting into strategies and what you should be doing. So it should definitely be a big help to your trading game. All right, we are starting right now. I want you guys to look at these 3 words: scalping, intraday, and swing trading, and understand what they really entail. So these are 3 different trading styles that are offered, not really offered, but that most traders are, whether they're in the stock market or currency market. So scalpers are traders who are looking to get in and out of the market fast. They use a high lot size with high leverage. They're only looking to gain 10 to 30 pips over and over and over again. They usually stick with volatile currency pairs and are glued to their screens, not using a stop loss. So traders are like this, for example. They get in on a trade, they use a very high lot size, and they're only in it for 15 minutes, 20 minutes, 30 minutes, get out, doing it again, 15 minutes, 20 minutes, get out, doing it again, 15 minutes, 30 minutes, get out. Like, that's what scalpers are. Intraday traders are traders who are looking to trade daily, get in and trade at 8 p.m. and get out by 8 a.m., get in at 3 a.m. and get out by noon. Intraday traders are looking to gain 40 to 80 pips, more or less. majority of traders in the world are intraday traders. So most traders like to be, in a certain trade just for that day. They don't like to hold it too long. They definitely don't want to hold it too short. They want to live their life and go to the gym and be with their family and do their normal things, but like close the trade before their session ends, whether they're trading London session, Asian session, or New York session. Let's just say New York session. Most traders like to, get in at 7, 8 a.m. and then get out at 3, 4 p.m. when the market's starting to close and, the market starts to reset itself, at 5 o'clock. Swing traders are traders looking for long-term gain. Get in a trade on Monday, get out by Friday. Get in on the 1st and get out on the 14th. Those type of examples. Swing traders typically hold their trades between a few days to a few weeks. They are looking for massive pip gains, such as 250 plus. They also usually have larger account sizes. So these people, analyze on the daily, the weekly, the 4-hour at like the absolute minimum. And they're looking to place 1 or 2 trades and then close their phone and open it up 5 days later, 10 days later, or however many days later. They're not looking to trade every single day. They're not looking to trade every 2 days. They're not looking to trade every 15 minutes. They're looking to hold on to their trades until there's a clear reversal or they maximize all their profits. So between these 3 different trading styles, which trading style looks the most convenient to you? Do you want to be glued to your screens and trade, every 15 minutes for, 2 hours a day? Or do you want to be an intraday trader where you trade 1 time or 2 times, depending on if you scale in, but have the whole day to yourself and then just close it by the end of the day? Or a swing trader where you place the trade and then you check back in a few days, let alone a few weeks. You guys figure that out. As you go on with the series, you guys will, like I said, I have scalping strategies in series 3 and swing trading strategies in series 3, but in series 2 is the intraday strategy. I am an intraday swing trader, meaning most of my trading is intraday, but I do have some swing trades that I hold from time to time, but I'm more so an intraday trader. But I have all 3 different strategies so you guys can see which one works best for you and you just apply it to when you start trading for real. So a big question everybody has that I know people are wondering in the back of their mind, what's the difference with the Forex market and the stock market? And that's a very, very good question. I'm going to break it down as much as I can without being biased. But, the Forex market is a lot more attractive to actual day traders. Just like I said it right here, just look at the comparison. The Forex market has $5 trillion worth of trading volume per day. The stock market only has 200 billion trading volume per day. The Forex market is open 24 hours a day. The stock market is only open for 8 hours a day. The Forex market has minimal/no commissions, but minimal. Stocks, obviously, it's more of a higher commission. Forex has, 70 plus currency pairs, but realistically, there's probably only 8 that matter. You know what I mean? The stock market has over 3,200 companies that can be traded on the New York Stock Exchange. So it's a lot easier to, focus on what a few currency pairs are doing than trying to pick 1 or 2 or 3, stocks to trade out of 3,200 plus. You know what I mean? In the Forex market, you can buy 1 pair and sell another. In the stock market, you can only buy the shares when you think it'll rise and sell to exit. But you can't just look at a stock and be like, all right, I'm just gonna sell it. Like, you can't. There's restrictions on shorting. Only like a select few can do it, but not your average daily trader can. When in the Forex market, anybody can buy, sell, whatever the case may be. You can profit off of, a currency dropping or weakening. You can't really profit off of a stock or a company dropping. But it also depends on your trading style. If you're looking for short-term trading or even medium-term trading, Forex has the advantage as it is more volatile. If you're looking for long-term growth, the stock market would be way more suitable because the volatility in the Forex market can be seen as negative, whereas the stock market doesn't change directions as often. So stock market, it changes directions, but not nearly as much as the Forex market. The Forex market be moving, like it goes up, down, sideways, up, down, where the stock market is going like up, sideways, up, down, up. Like it's slower than the Forex market, and that explains obviously the day trading volume. The same technical analysis is applied. So what you should understand is that no matter what, the technical analysis you're about to learn in Forex is the same exact thing with the stock market. Understanding candlesticks, Fibonacci, market patterns, they're all the same. The difference is what moves each market. The Forex market is caused by interest rates and what the economy is planning on doing with their respective currency. The stock market is heavily dependent on companies and their revenue and how they can help stimulate the economy. So basically, Forex is very technical based, whereas the stock market relies heavily on fundamentals, like heavily, heavily, heavily. It truly depends on your trading style and who you are. The Forex market is not as regulated as the stock market is, which can provide way more money, but also way more risk. So we dive more into it as the series progresses, but we go into it intensively, like really, 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 really deep, everything you need to know in the mini course, which is taxes and brokers, because obviously it's a big part of taxes in general and regulation. So don't get me wrong, the Forex market, you can easily trade the Forex market in the United States. It's just not looked on as much as the stock market is. Like the stock market is like, everybody knows the stock market. Everybody's like, all right, stocks. Nobody trades currencies too much. Where in other countries, all they, like the UK, all they do is trade currencies over there. You know what I mean? Like that's heavy over there. Whereas in the United States, it's more so heavy on the stock market, because a lot of people who are investing in the stock market, they're investing with $25,000 to $30,000. Plain and simple. So they are always looking for long-term growth. You don't find too many, day traders in the stock market who are day trading every single day. Now, there are a lot of them, but the ones who are investing in the stock market, who put a trade in on Monday and then they check back in later, severely outweigh those who are, in and out within 2 seconds, like the scalpers. Now, with the Forex market, a lot of it is so interesting to people, like us. Now, obviously, I have a higher account size, but when I started, it wasn't that high. It's so much easier for people like us, where we may have $500 or $2,000 or $10,000 or $5,000, because the Forex market is very liquid. So you can turn that 2,000 or that 1,000 into 20,000, into 30,000, but you got to be very, very smart with it. It's not easy, but the Forex market allows for more wiggle room and for you to do many more things than the stock market does. Obviously, back to the point about in the Forex, you can profit off of a pair dropping, and you can profit off of a pair going up. Where the stock market, you can really only profit if a pair goes up or the stock goes up. So I hope that makes sense to you guys. Just do your research on which market fits better for you, because for me and a lot of others, the Forex market is better for us. And there's nothing wrong with mastering the Forex market and then using that money to get into stocks. I am in both, but I started out, perfecting how I am in the Forex market. And also, I like the volatility. I don't like how slow stocks are, whereas the Forex market, it moves. You know what I mean? Like, I get some action, whether I'm an intraday trader or a swing trader. I at least get some action where I understand, like I know what's going on. I know if I place this trade, I know this pair is gonna move this much. Whereas if I'm trying to trade Netflix, I gotta figure out what's going on with the fundamentals around Netflix, what their CEO is gonna say, and I do all this research, and it may not even move that much during that day, that trading day. You know what I mean? Or the Forex market, I know every single week at Tuesday at this time, gold is gonna move up. Or I know every Friday, the first of every Friday, the United States has a lot of news coming out. Like it's a lot easier to gauge what's going on with currencies, because obviously like these people in the government are meeting once a month, if that, sometimes 8 times a year. Like I know FOMC is a major news announcement, the Federal Open Market Committee, which we'll get into in Series 4, and they meet 8 times a year out of 12, and those 8 times help shape the market. Monetary policy, they help shape the market. Whereas with stocks, anything can happen with Tesla. People saw a few weeks ago how Tesla just dropped because Elon Musk made one tweet. Whereas tweets don't really affect the currency market that much. Nobody can just tweet something and then euro and then GBP and all these pairs are just going to drop. But with the stock market, if you're trading Tesla, Elon Musk can say one thing or say one thing wrong in an interview, and then boom, it plummets a little bit. You know what I mean? So you got to be mindful, and this is the reason why I prefer Forex over stocks, is because I feel like I have more control over what's going on. With both, markets, there's really no control. Like you really don't have any control on what happens. But I feel like you can easily adapt and react to what the market is doing in Forex than you can with the stock market. So I hope this video was a little bit, eye-opening for you guys. You guys, look back on these two things. I have a PDF attached so you guys can, download the PDF and study it on your own terms to figure out, which market suits best for you. But obviously, if you bought this course, you are interested in learning Forex, which is what I do. And if you're interested in learning Forex, then continue on with the technical analysis section, because the Forex market can and is the most lucrative market out of all the markets possible, but it does come with a lot more risk because the leverage can be higher with Forex, whereas the stock market, they kind of restrict you on what you can do. So I definitely go into deeper as the series goes on, but it's not important to really know the difference between the Forex market and the stock market right now. I just want to give you guys a heads up just so you guys at least know what you're doing and what you're trading. This is day trading, but this is day trading the currency market, the Forex market. This is not day trading the stock market. While they are both similar, they are definitely very different as well. So when somebody asks you, what are you? I'm a currency trader. I'm a Forex trader. You're not a stock trader. You're not a stock trader yet, unless you trade Apple, whatever the case may be, because some brokers allow you to trade stocks as well. Stocks and currency at the same time. So, yeah, I just wanted to give you guys like a heads up. But like I said, as the series goes on, I definitely get deeper with, the analysis on Forex and stocks in general.